Hello, good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again, the Senior Market Analyst of OANDA Asia Pacific. Very good morning to all. Today will be Tuesday, the 9th of April, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a recap of what has taken shape yesterday during the European session and as well as the US session, and in terms of market performance in the broad-based cross assets and as well as any related economic data or other events that triggered a significant movement in the market. So yesterday was a relatively quiet economic calendar. So like I mentioned in my daily dose yesterday, no major events or data that's on the horizon. So yesterday market was pretty quiet as well in terms of the price actions. So what we could see over here is gold price, spot gold XAU/USD continue to be remains resilient in this ongoing medium term and short term uptrend phases, continue its impulsive up move structure. So yesterday, gold price XAU/USD added another daily gain of positive 0.4% to reach another fresh all-time high, and as well as WTI crude oil, West Texas crude oil, managed to actually inch down slightly to negative 0.2%, as very likely I shared with you all yesterday in its short-term technical configuration is undergoing a short-term corrective minor pullback phase within its short and medium-term uptrend phases. So as you all know that prices do not go vertically up or vertically down in a linear fashion. They actually oscillate within trends. Okay, so this what's WTI crude oil price is actually experiencing right now potentially. And if you will look into the major US stock market performance has been pretty much lackluster within our expectation as well. Why? Because like I mentioned earlier on at the start of this week daily dose, the US economy and in fact globally potentially could face a much more tighter liquidity condition. Why? Because the US Federal Reserve officials, in their mindset, they have a kind of a major reset or rethinking of that Fed dovish pivot narrative, where several two key Federal Reserve officials has been skewed towards the less dovish camp, and even one of them actually suggested potentially there could be no interest rate cut this year. So given the fact that that actually drive the US 10-year Treasury yield higher yesterday towards the upper limit of a major resistance at 4.5%. So given that tighter liquidity condition, higher cost of funding potentially could eat into the net profit margins of US corporations. So that actually explained yesterday lackluster performance of the US stock market. So if I could share with you the intraday performance of the US stock market, as you could see on my screen over here, in your screen, pardon me, over here is this. All right, so we could see that this is the intraday performance of the S&P 500 yesterday. Initially it recorded gains, but throughout the session this gain dissipated and it ended almost unchanged, negative 0.4%. Very similar performance is seen on the Nasdaq 100 as well. You could see on my chart the Nasdaq 100. All right, okay, it's a bit slow. Yeah, gains will wipe out as well. And even on the Dow Jones Industrial Average, very similar performance. Earlier initial gains will actually wipe out throughout as we head towards the close of yesterday's US session. All right, so if you look at the heat map, okay, let me give a couple of seconds. Yeah, this is Dow Jones. Okay, initially positive, then thereafter, as the US session gets going yesterday, the initial gains were actually wiped out by the close. All right, so if you were to look at this performance on a intraday basis on the major US stock indices, it indicates to us lackluster movement, and potentially we could be in the midst of undergoing this multi-week corrective decline on the major US indices, on the S&P, the Nasdaq, the Dow Jones, within its medium-term uptrend phase. Okay, so if you look at the heat map of the S&P over here, what we could see is that there are more rates that are being seen on the Magnificent Seven stocks. That means the 7 major big cap stocks that govern that has a significant impact on the S&P 500. Apple down negative 0.67%, Nvidia down negative 1%, Meta, Facebook down negative 5.3%, and Microsoft down negative 0.22%, and Amazon almost unchanged, negative 0.07%, and Tesla is up a positive 4.9%. It's more of a counter trend rally given its persistence year-to-date underperformance against the rest of the Magnificent Seven. So if you flip to a year-to-date performance chart, yeah, year to date. So what I could see is that Tesla is actually underperforming, down negative 30%, and followed by Apple, which is down negative 12% so far year to date. Okay, so that's actually explain why Tesla was actually outperforming yesterday. It's more of a counter trend rally or counter trend rebound phase, I would say. Now, with that, that's pretty much sum up the story of yesterday's movement, and dollar was actually mixed yesterday as well, going sideways. And any key economic data so far at the start of today's earlier Asia session? Yes, there's one I want to highlight. It's related more to Australia. So today is Tuesday. So before we speak at 11 a.m. today, at 8:30 a.m. Singapore time, there was a release of consumer confidence data in Australia. We call it the Westpac Consumer Confidence data. So this is the index and the change. I will just immediately focus on the change because change tells me the difference. So what we could see over here is that there's actually a slight dip in consumer confidence in Australia, down negative 2.4%, much wider than negative 1.8% that was seen last month, which is the month of March. So if we were to put it the trend in terms of the change, all right. So what we could see over here is another two consecutive months of decline in consumer confidence. Okay, so these two consecutive months of decline is being last seen is almost a year. So the last time was in July. Okay, July last year. So all in all, what we could see a kind of a muted consumer confidence in Australia. So that could actually potentially allow the RBA to be less hawkish instead going forward. So that could actually cap any potential Aussie strength as well from a fundamental perspective. All right. So with that, that is the key news flow and fundamental linkage that I will share with you all. Now, before we jump straight into the short-term technical outlook, there's one particular information I share with you all is the pricing of the Fed funds rate. So we know that the pricing of the Fed funds rate can be found from the CME Fed Watch 2 over here. So if you look at the aggregate probability over here, by clicking on the probability, focus on the lower table. So this lower table gives us a snapshot is no change and high in terms of accumulated probability based on market expectation through the Fed funds interest rate futures market. All right, so initially, right at the start of the year, previously the first interest rate cut is being penciled in March, and after the we call it a latest Federal Reserve speak together with a slew of latest respective key economic data from US, CPI, inflation, and whatsoever, the first interest rate cut has been continuously being pushed down the calendar. So previously from March, it's been pushed down to June. So June right now, at the end of last month FOMC meeting, that means on the 20th of March, there's actually a high chance of close to about 70% that markets expecting the first cut to come in June. But however, after last week's new Fed speak narrative or guidance and the rate hot non-farm payroll data, that 70% odds has been reduced to 50%. Okay, so right now there has the market going to pencil in the first cut to actually instead come in July with a 68% chance, okay, in July. But the number of interest rate cuts has been significantly reduced. Initially, for 2024 market starts to price at the start of the year 6 interest rate cuts. Then somewhere around in February and March, it be reduced to 3, and right now it has been reduced to 2. If you look at it diagonally down over here, so this is the one that is in cyan blue, diagonally down. So now it's 5.25% and 5.5%. Okay, let me expand my screen so that you guys could see clearer. Okay, I think this is as huge as it goes. Okay, yeah, so this should be big enough. Okay, 5.25%, 5% is the current Fed fund rate. So if you go vertically down, okay, over here, this one potential interest rate cut, then over here there's nothing. Why? 2 times in November, and thereafter in December there's none over here as well. All right, so if you look at the way market is being pricing right now, it starts to price in lesser cuts at this juncture. So that's actually explained to us the current liquidity tightening condition, and potentially given this ongoing geopolitical risk tension that is happening in the Middle East, and given the US presidential election that is upcoming next, we could see much more rhetoric by the two presidential candidates. Trump for sure, he'll be the Republican choice, and very likely Trump has really indicated that one of his pledge is to make America great again via imposing potential trade tariffs that is nation that are not friendly with America. So the one that's being singled out will be China for sure. So given the next half of the year, there could be much more populistic slogan that is being played out from Trump, making another potential trade war with China. So that could actually increase the geopolitical risk tension. And that being said, that could actually drive higher oil prices from a supply side of the story. And given interest rate right now expectation in US has starts to be tapered off the interest rate cut cycle, so that could actually increase demand crunch, increase the risk of supply side inflation. So these two elements will lead to a revival of stagflation risk. So that actually explain why gold price continue to remains rather on a firm footing, given the fact that gold tends to be benefit from potential stagflation risk scenario. All right, so that the fundamental story that I'll share with you all. So right now, let us now straight away jump straight to the short-term technical outlook. So let us start with the major stock indices first. Okay, Asia Pacific, Hong Kong 33, which is the Hang Seng Index over here. So now let me expand my screen so that you guys could see. So yes, the Hang Seng Index at the start of the Asia session today managed to do a spike up, but this spike up once again getting rejected from our short-term pivotal resistance that we highlighted earlier, 16,960. So for sure, this is indeed a key short-term pivotal resistance that preventing the potential boost from actually be much more bullish. So every time we hit this level, there's some kind of hesitance by the bulls to push the Hang Seng Index much higher. So no change. We'll be using 16,960 as my short-term pivotal resistance to maintain this short-term bearish bias on the Hong Kong 33 index. First support to watch will be at 16,650 level over here, which is also correspond to the 20-day moving average. A break below 16,650 exposes the next near-term support level, pardon me, not resistance, near-term support level at 16,335, which also confluence with the 50-day moving average as well. Only an hourly close above 16,960 will invalidate this short-term bearish bias to see the continuation of this ongoing potential counter-trend rebound scenario to expose the next resistance to come in at 17,230 and potentially even 17,560 slash 17,600, which confluence with the downward sloping 200-day moving average as well. Japan 225, the Nikkei 225 continue to trade within this short-term descending channel that I drew from the minor high of 27th of March, indicating to us right now is in the midst of ongoing this short-term corrective decline phase scenario within its medium-term uptrend phase and major uptrend phase that is still intact. So all in all, no change. Price action still refuses to break above the 20-day moving average that has been taken out last week, and also correspond close to the upper boundary of this minor ascending channel upper limit. So with that, I don't want to target so tightly at the 39,990 level. I will still use the 40,260 short-term pivotal resistance. Bear in mind, this is the tipping point that actually triggered last week's steep decline. 40,260 short-term pivotal resistance to maintain that short-term bearish bias on the Japan 225. So in first step, watch these two near-term support level, 39,070, followed by last week low at 38,770. We also correspond to the 50-day moving average, I think, as a support level as well. Only hourly close above 40,260 will invalidate this short-term bearish bias on the Japan 225 to potentially kickstart another round of impulsive up move. Next resistance level to watch, 40,760 in first step, followed by 41,150 in the which is the current all-time high area. European currency, European indices, the German 30. So German 30, yesterday we flipped to a short-term bearish bias. Why? Because price action actually broken down below the minor ascending channel support that I drew from the low of 14th of February. Potentially, right now we are in the midst of this minor corrective decline phase for the German 30 index to actually do a bit of retracement of its 3 months steep up move. Okay, so no change, still using the 18,000 485 short-term pivotal resistance level to maintain that short-term bearish bias on the German 30 index. So right now, we will have a first support level to watch for today, which is over here close to the 20-day moving average, and last Friday minor swing low area, conferencing at the same area of interest as well, 18,190. So that is the first support level to watch for today. A break below 18,190 exposes the next near-term support at 18,050 level. Only an hourly close above 18,485 will invalidate this short-term bearish bias on the German 30 to potentially kickstart another round of impulsive up move. First resistance to watch next will be the current all-time high at 18,650, followed by 18,775. US indices, the US Wall Street 30. So as usual, can't break above the first resistance level at 39,080, which is very slightly below the 20-day moving average. But I'll be no change. I don't want to use 39,080 as my short-term pivotal resistance level. So I'll still maintain that 39,365, which is the tipping point that triggered last week's steep sell-off. So 39,365 short-term pivotal resistance on the US Wall Street 30, maintain that short-term bearish bias. First support level to watch, 38,450. All right. Only a break below 38,450 exposes the next support zone, 38,200, 38,060 level. Only hourly close above 39,365 will kind of invalidate the short-term bearish bias to potentially kickstart another round of impulsive up move. First step will be the current all-time high area, 39,990. Above it sees the next resistance coming in at 40,245 level based on a cluster of Fibonacci extension level. Nasdaq 100. So similar to the Dow Jones Industrial Average, still can't break above last Friday's high, which is at 18,230. We also confluence with closely the 20-day moving average, acting as a resistance, and as well as the former minor bearish ascending wedge support, now acting as a pullback resistance as well. This dotted pink line over here. So I don't want to target so tight at 18,230. So still using 18,470 just in case of any whipsaw. So this 18,470 as my short-term pivotal resistance on the Nasdaq 100. Still maintain that short-term bearish bias. First support level to watch, 17,840. A break below it exposes 17,560 next, which is the minor congestion area of 20th of Feb and 21st of February. Only hourly close above 18,470 invalidate this bearish bias scenario to kickstart another round of impulsive move. Bullish impulsive move with the next potential resistance to come in at 18,620, followed by 18,880. All right, so to sum up everything is that the major US stock indices that I highlighted earlier on still shows risk of a potential minor corrective down move sequence. FX market. All right, let us start with the European currency. So as I mentioned over here, the FX market still remains mixed. So as depicted on the daily chart of the dollar index, current strength can't break above the previous swing high of 30th of February. Tested one time, tested twice on last week at 104.94, but it also can't break below a bunch of near-term support at 103.70, which confluence with the 20-day, 50-day, and the 200-day moving average, also acting as a support at this similar level of 103.70, the dotted green line over here. So what we could see over here is that the dollar story appears to be mixed at this juncture, given that the dollar index is being trapped between these two levels. So with that, the euro dollar in the short term, we maintain that short-term potential bullish bias for this push-up to test the upper limit of this symmetrical triangle range configuration that I drew from the low of 14th of February. Okay, over here is a symmetrical triangle range configuration. So with that, I will have a tighten key short-term pivotal support level for today, 1.0820. As long as this level holds, potentially the euro dollar could continue to evolve within the upper limit of this symmetrical range configuration, with the resistance coming in at 1.0890. Only an hourly close below 1.0820 will invalidate this short-term bullish bias within this symmetrical triangle range configuration to potentially see it float down towards the lower limit of this symmetrical range, with the next support coming in at 10775. A break below it exposed the lower limit of the symmetrical range triangle, which will confluence closely with last Tuesday's minor swing low at 1.0725. Sterling dollar. So sterling dollar yesterday, we also have that short-term bullish bias to see a potential push up to retest the 50-day and the 20-day moving average, and as well as the minor descending trend line from the high of 8th of March, all right, at 126.85. So that level is more or less has been met. So yesterday, today's Asia session, it managed to print a high of 126.61. So with that, are we flipping to a neutrality bias side bias for the sterling dollar for today? So neutral between 126.85 and yesterday's swing low area at 126.10. All right, so neutral between 126.85 and 126.10. So that's for the sterling dollar. Asia Pacific currency, Aussie dollar. So Aussie dollar yesterday managed to squeeze up and retested the upper limit of this symmetrical triangle range configuration that is in place since 14th of February. I drew. So very similar to the euro dollar, but it already met this upper limit of the symmetrical triangle range configuration. Symmetrical triangle range configuration, the upper limit, which is at 66.15, and now start to show signs of hesitant over here by two consecutive hourly bearish shooting star candlestick here and here. All right, so I don't want to use it too tight at 66.15, just any whipsaw, so I'll put it up at 66.50. Still no change. So that's yesterday's short-term pivotal resistance level, which is also the 21st of March minor swing high area that actually led to this intraday significant sell-off earlier 2 weeks ago. So with that, no change, 66.50 short-term pivotal resistance to maintain that short-term bearish bias within this symmetrical triangle range configuration. First support level to watch for today will be 65.60, which is also confluence with the 20-day moving average. A break below it exposes 64.40 in the first step. Only hourly close above 66.50 will invalidate this move. Then potentially we may start to see a push up to retest the 8th of March swing high area at 66.55. Above it exposes 67.10 next, which is this congestion area over here of 11th of Jan and 10th of Jan, and also the 61.8 Fibo retracement of that previous decline from 28th of December to 14th of February. All right. Dollar yen, so no change. Dollar yen going to trade sideways as well, but still holding below the major resistance level at 151.95, with the fear of intervention coming into the picture again as well. So more of a sideways range configuration. So using 651.95 as my short-term pivotal resistance. First support level to watch will be at 50.90, which confluence with the 20-day moving average as well. All right. With an hourly close above 51.95 will invalidate this short-term bearish bias to kickstart another round of impulsive move. Next resistance to watch 52.80, followed by 53.60 on the dollar yen. Right. So right now spot go. So spot go no change, as we couldn't mention, it's going to actually evolve within this impulsive up move. So what we could see over here is that it starts to actually oscillate within this minor ascending channel that I drew from the low of 27th of March. And hourly RSI is also showing no signs of bullish exhaustion as price action continues to trade higher high above the 50-day moving average. And right now there is no sign of a bearish divergence on the hourly RSI as well, supporting further bullish impulsive up move in the short term on potentially on the spot gold XAU/USD. So with that, we'll have a tighten key short-term pivotal support level for today, 2,300, which confluence with yesterday's low, and as well as the lower limit of this minor ascending channel that I drew from the low of 27th March. So as long as 2,300 short-term pivotal support holds, in any potential dip over here, we will still maintain that short-term bullish bias on spot gold. Next resistance to watch 2,370 followed by 2,400, which is the upper limit of the minor ascending channel as well. Only an hourly close below 2,300 will potentially kickstart a much more a deeper minor corrective pullback with to expose the next support level at 2,266. A break below it exposes 2,206. We also confluence closely with the upward sloping 20-day moving average. Lastly, will be WTI crude oil, West Texas oil. So as we mentioned, West Texas oil right now is in the risk of shaping a minor corrective pullback within its short-term uptrend phase, as depicted by this ascending channel that I drew from the high of 5th of February. So right now it's actually at the upper limit of this ascending channel, using 89 short-term pivotal resistance to maintain that short-term bearish bias for this potential minor corrective pullback to play out on West Texas oil. First support level to watch will be 84.90. That is confluence with yesterday's swing low as well. Yesterday's low, I would say, a break below 84.90 exposes the next near-term support at 83.20, which is the former minor swing high area of 20th of March being retested on 1st of April, and also confluence with the 20-day moving average as well, coming in at 83.20 level. So it's more of a minor corrective pullback scenario that is potentially could play out in West Texas oil. However, a break above 89 figure level, that's the short-term pivotal resistance, will invalidate this minor corrective pullback scenario for West Texas oil to see the continuation of its impulsive up move sequence. Next resistance to watch 90.70 followed by 93.40 level. All right, so with that, that pretty much sum up the short-term technical outlook on the broad-based cross asset classes. So before we go, let's take a look at the calendar of what are the key events to look out for today. So other key events, okay, let me refresh. All right, so other key events to look out for today that could be announced in the second half of the Asia session will be China data. So far, there's no exact time that's being given. So this is more of a M2 supply, taking into account of how banks are lending in the China economy. So M2 supply followed by outstanding loan growth amount. So this is a data to look out for. If we start to see a substantial increase in outstanding loan growth, that means indicate to us that banks in China is getting much more confident, all right, in lending out credit. Then thereafter, in the European session, nothing much, pretty much interesting over here, and also the US session, there is not much key data to look out for as well. So another relatively quiet day before Wednesday. Interesting data. So Wednesday will be interesting. Why? Because this coming Wednesday we have the all important core inflation data that could market participants will be paying very close attention to. That's 8:30 p.m. Singapore time, and earlier before the start of our daily dose at 11 a.m. at 10 a.m. we have RBNZ interest rate decision. So that is very much likely unchanged at 5.5%. Okay, and then we'll talk more about this tomorrow at the start of our daily dose. Okay, so with that, I wish you all a great day ahead. Okay, so in fact, I forget about this. Tomorrow there will be no daily dose because tomorrow is a public holiday in Singapore. So daily dose will resume on Thursday morning instead. All right. So with that, do have a great day ahead. And for those who are celebrating Hari Raya, I wish you all a great Hari Raya as well. So thank you for your time, and I'll see you all again soon.